Today, we're going to talk about tax strategies that cover health savings, retirement fundings, charitable contributions, and more. This is part two of year end tax strategies. These tax strategies can reduce your taxable income, which, if you use those savings and invest, you can build long term wealth. My name's Anthony Brister. This is a wealth planning podcast with Brister Law. Like I said, today we're going to talk about personal and family deductions for year-end tax planning. First up, let's talk about the HSA. The HSA, or the health savings account, is used for those who have a high deductible plan for their insurance. Right now it's open enrollment period, so if you're not sure what kind of plan you have, go take a look. Right now is the time to sign up. If you have low medical expenses, or if you really want to invest and save for long-term medical, the HSA is a great tool. The HSA offers triple tax benefits. So first off, when you contribute to the HSA, you get a deduction for that. The earnings, you're allowed to also invest what you contribute, and those earnings grow tax deferred or tax free, depending on how you withdraw it. If you withdraw those funds for qualified medical expenses, those funds also come out tax free. Now, if you wait until retirement and pull it out, those can be taxable just like a IRA. So if you don't have medical expenses and you build up a large amount in the HSA, you can also take that out come retirement time. So what you really need to consider, though, for the HSA is, first, do I qualify? Am I in a high deductible plan? The contribution limits for 2024 are $4,150 if you're single and $8,300 for families. If you're over 55, you can contribute an extra $1,000. It's not too late to contribute. You've actually got till April of next year to make these HSA contributions. So, if you don't have the money yet, be on the lookout. This is one of these tax planning strategies that, if you miss the December 31st deadline, you're still not too late. So you've got till April of next year to do the funding. Next up is actually use it or lose it type of account for your health, and that is the FSA, the flexible spending account. This is a great tool to use too if you've got a little bit higher medical expenses, or you don't want to pay for that high deductible plan. You've got kind of a lower deductible plan. This is a use it or lose it tool. In 2024, I believe you can contribute up to $3,200 in this account, and you've got typically to the end of the year to spend that account down for qualified medical expenses. Common expenses, people use prescription drugs, over-the-counter items, your deductibles, things like that, right? Some plans do have a grace period going into that next year. It's always important, though, to check with your plan and make sure what qualifies also, when that grace period, if there is a grace period or carryover, is allowed. So check your plans for that. The FSA also is a great tool if you've got those yearly expenses that are accruing and you don't want to self-insure or pay for the high deductible plan. So the last health account / savings account really that we use, it's not really a savings account. What this is the health reimbursement arrangement or medical reimbursement plan. This really is a great tool for those who are self-employed, who have large medical expenses each year. You have to structure properly. So depending on if you're a solopreneur, if you've got employees, what kind of business you're operating out of, You might have to do some restructuring or create another entity for this, but the HRA is a great tool that does not have a cap. It is a year by year thing, so you use it as you go, but you can reimburse yourself tax free for qualified medical expenses. This is under Section 105. It's a great tool. I use it in tandem with the HSA. So I reimburse myself using the HRA while also contributing to the HSA to allow that to grow tax free. Great tool. Talk to a tax advisor if you're interested, because there are some nuances with this. Next up, we're going to change gears a little bit, talk about retirement planning. So um, it's really different for if you're employed or if you're self-employed. There's a couple different routes you go, and then there's the IRAs, right, that everyone can contribute to. If you're employed, really, really simple. You typically have a 401k. If you're in a nonprofit, you might have a 403b or something along those lines. The contribution limits are 23,000. If you're under 50, if you're over 50, you've got an extra 7,500 that you can contribute. So up to 30,500 a year, you can put back into your 401k. For IRAs, you're also allowed to put up 7,000 if you're under 50 and 8,000 if you're over 50. You must have earned income for this. So, for those who are retired or only making money off of other investments, you have to have earned income to do the IRAs and also the 401ks. But I'll say for the IRAs, sometimes people get confused and say, I make too much money to do an IRA. There's something called a backdoor Roth. So if you are over those contribution limits, you still can contribute to an IRA. It's just that you don't get the tax deduction. So what I would suggest is the backdoor Roth strategy, where all it is contributing to the traditional IRA and then immediately moving that money over to the Roth account. If you do have a large built-up account in traditional IRA money, there are some pro rata rules that might throw a loop in there. So talk to a tax advisor if that's the case. But if you have no traditional IRA money built up, the Roth conversions are a great tool. And that also leads us into the next strategy, really, which is Roth conversions. So if you do have those large built up IRAs and traditional IRA money, and all that means is that's pre-tax. So traditional IRAs, typically you contribute and you get a tax deduction in that year. When you take it out, you have to pay taxes. With the Roth accounts, you pay taxes in the year that you contribute, and then when you take that money out, it comes out tax-free. So what a strategy a lot of people like doing, and it's a great strategy to build long-term wealth, tax-free wealth, is to convert any traditional IRA money or traditional account money into Roth accounts. You have to pay taxes on that amount that you do convert in the year. But remember, you never pay taxes in to begin with, and then you'll never have to pay taxes on that money again. It's important to consider your tax brackets. A lot of people don't want to be moved up a tax bracket when converting. So if you're in a low income year, if you've got some short-term rentals, built up some large active losses as well, could be a great tool or a great time to consider chunking. If you just recently retired, don't have the RMDs yet, income's dropped, also consider chunking and doing those Roth conversions. Always want to meet with a tax advisor to make sure that you completely understand what you're getting yourself into, and to properly save for those taxes that would be owed if you're doing that conversion, though. Also, if you're self-employed and you're a solopreneur, the solo 401k is a great tool. You can put up to 69,000 a year in 2024 back in retirement. Talk with advisor, though. Again, you want to make sure that this plan is set up right. But if you're behind, or if you really want to start putting back a lot of money, the solo 401k is a great tool to do that. Lastly, let's talk about charitable contributions. So, first, I think a lot of people get things wrong when we're talking about charitable contributions. One thing that I see people not really understand is um, in order to really get the benefit of a charitable contribution tax wise, right? We're not talking about the benefit of gifting and everything that comes along with that and being charitable. But tax wise, in order to get a tax benefit, you have to get over the standard deduction amount before you start getting the deduction. So all that means is if you're single, let's just say, go single, for example, uh, on your Schedule A, there's different types of deductions. So we've got property tax, medical. A lot of people aren't going to get medical because there's a special rule, 7.5% of your AGI in order to deduct. But property tax, medical, um, mortgage, charitables, student loan interest, things like that, those are all deductible. In order to actually make a tax benefit, you have to get over the standard deduction amount. So what the standard deduction amount is Congress just basically gives that to us and basically says, hey, if your itemized deductions on your Schedule A are lower than this amount, you can take this standard deduction amount and we'll call it a wash, right? So right now that's around 14,000. So if all of those Schedule A items are less than 14,000, you're going to get the standard deduction amount. So if you donate 10,000, you're eating up 10,000 of your standard deduction amount, and you still have that 4,000 left, so you get that $14,000 deduction. So really, for you to get anything more, you have to give over that 14,000 to start getting a bigger deduction amount. Hopefully that makes sense, but that's something I think a lot of people miss. So when we're talking about charitable deductions, paying your property taxes, all these Schedule A items, what we do a lot of times is we chunk them together in years. So instead of doing my charitables in 1 year or every single year, I'll do it for 2 years in 1 year. Same thing with the property taxes. I'll pay at the beginning of the year and at the end of the year, right? So I can get over the schedule, the standard deduction amount by chunking these items, right? So hopefully that makes sense. It gets missed a lot. Second thing with charitable deductions, for those who are over 70 and a half, who've got required minimum distributions, RMDs coming up, there's something called a qualified charitable distribution, QCDs for short, and you can give up to $100,000 a year to a charity directly from your IRA. By doing this, you're actually eating up your standard deduction, or not your standard deduction, your RMD amount. So each year, if you are being charitable, you can use your retirement account to actually do this if you got an RMD issue, and that never hits your Schedule A. So this is also a great way to, one, mitigate your RMD tax issue coming up, but then two, also to eliminate that Schedule A expense and get more of your standard deduction back. Lastly, if we're gifting things or donating things. Donating appreciated assets is always a great tool if you've got a built-in gain. The charitable remainder trust, too, also a great tool for those with large built-up capital gains. So that's really it for today. We talked about personal, family expenses, your health accounts, different ways you can get deductions for taking care of yourself. Talked about retirement accounts and also the charitable contributions. If any of this sparked your interest or you want to take a deeper dive and save money and taxes, learn how to build and generate long-term wealth, please go to bristertaxlaw.com. Go schedule a discovery call, ask for a comprehensive consult. Do this before the year ends so we can take action and actually take account for what you're doing. Make actionable steps before the year ends and start saving money now and being proactive with your tax planning. If you like this video, please like, subscribe, comment, and thank you for joining me today.